The broadcast is now starting. All attendees are
Hello
in
everyone,
listen-only
welcome
mode.
to our webinar, Methods of Portfolio Management. Our speaker today is Mr. David Ho and our moderator, Edna. Before we begin, I would like to do a disclaimer that everything we share in this webinar is just for educational purposes and in no way that we recommend any buy or sell. Also, if you want to buy or sell these stocks, it's up your own decision, alright? Before we begin, I would like to do a sound check for those of you who can hear me. Please raise the hand button. Alright, you can see the raise the hand button. Okay, I am seeing some hands. Okay. Alright, everyone can put down your hands now. Alright. Okay. So as some of you may know, this is our last topic for this year. So after learning everything about UCAN from different products such as ETFs to value investing and also warrants and even using different methods such as momentum-based business or SMA. Today we have come to the most important topic, which is teaching you how to manage your portfolio. And our speaker today, Mr. David, is an engineer by training, and after he began his career as an engineer, he turned into his passion to value investing. After for 3 years, he managed to first have advanced portfolio management. Thereafter, he set out to pursue his own aspirations, establishing the Spiral Thinker Alliance. And today, being an investor, it's time to nurture the youth in financial literacy. And he's also often speak in seminars, webinars, as well as SUSA and those events. Alright. He's also featured in publications like Focus Malaysia. On top of that, does consultation services in value investing and advanced portfolio strategies for high net worth individuals. Welcome, David, to tonight's webinar. Alright. So can you share with our attendees what is portfolio management and why is it so important?
Right. First of all, thanks to Edna and LifeChamp for inviting me here for your final webinar of the year. I think it's quite timely since you guys, most of you who have followed through the series, you will have learned a lot of techniques, on how to buy and sell stocks. But at the end of the day, as long as you have more than one stock, it's actually having a portfolio. So how do we manage that is actually of absolute importance. That's why we have to. Now, as Anna mentioned, I used to be an engineer, so I tend to do things in processes. So for today's webinar series, I will be speaking to 4 sections. All right. First of all, we'll start with why do we need portfolio management, the necessity, all right, of why we need to manage portfolios as compared to just managing stocks. We're going to move on after that to simple concepts, very important concepts, and how to manage your own portfolio. We're going to go through some basic portfolio parameters to get you started. And last but not least, we're going to go through some very basic methods on how to optimize your risk and performance of your portfolio. Right? So feel free to send your questions through the webinar platform. We will try to answer as much as we can during the session. Yeah.
Okay, sorry, because some of the attendees is saying that there is an echo. So is the sound better now? Is the sound better now? Still same, is it? Okay. Still got echo?
What? How about if we speak nearer?
Okay, it's better now, right? Can we continue? Okay, all right. Sorry about the problem.
All right. Okay. Let's start off with why is it important to manage portfolio? Okay. Now, as I mentioned before, as long as you have more than one stocks in your holdings, you basically have a portfolio already. A lot of people think that, let me put it this way. If you be sure that every time you buy a stock, it will make money for you 100% day in, month in, month out, and year in, year out, without need portfolio management. You just buy. It's true, you make money, right? But how many of us can do that?
Very few.
Exactly. So the essence of portfolio management is not to maximize your return, but it's actually to spread your risk. Okay. So the first reason why we need portfolio management is really manage our risk. Now, what do we mean by managing our risk? Basically to see how are we exposing our capital. When we say capital is basically, right? For example, are we putting too much money into one stock? Let's say you have 100,000 ringgit portfolio. If you have 90,000 invested into one stock, that is what we call concentration risk. Now, I had another case. I used to be a student about 5-6 years ago. Her portfolio is doing very well. I think her KR, compounding annual growth rate, was even about 20% per annum, right? 6 times better than NT. But when I look at the portfolio, I realized that all the stocks are in foundation. Meaning all the KLKs, and water colors. Of course, portfolio was performing very well because CPO price was more than 3,000 per ton. So of course her portfolio. Okay, but imagine she didn't realize that, and she had carried on the portfolio until today, where CPO price is trading below 2,000 ringgit per ton. Her portfolio would be suffering, isn't it?
Yes, correct.
Yeah. So that is also part of how we want to manage our risk. Yeah. Then I talk about concentration. On the other hand, there is also something called the under allocation. For example, if you have 100,000 ringgit portfolio, and you put 5,000 ringgit into a stock, and that stock double up, do you make a lot of money?
Definitely,
right? But what if you just put a small, let's say 2% of your portfolio, 2,000 ringgit, into that stock, and the stock double up? So you make 2,000, right?
Correct.
Okay, on a stock level, yes, you double up, but on a portfolio level, you make 2,000, which is only 2%. You understand?
Yes.
So we need this to manage so that we have a bird's eye view of how we are managing our portfolio. Now, secondly, again, it's about assessing our performance along the way. Now, every time I always advocate that before we invest, we need to set our goals first. For example, you want to start with 100,000 today. How much you want this to grow in how many years' time? So you need to set a goal properly so that you can track it over time. And why this is important? Because markets don't move in one direction. Markets goes up and down.
Correct.
All right. Like what's happened this year, I think all asset prices is coming down in 2018, right? So when things like this happen, we have to assess our performance. Say, okay, so our portfolio is suffering this year. So what do we need to do about it?
How can we save our portfolio?
Correct. So conversely, on the other hand, when times are good, when our portfolio is doing very well and above our expectation, what should we do? Should we take profit? Should we continue to plow more money in? So these are the things that we need to know, all right, when we manage portfolios. Now, thirdly, it's a very simple question. It's a very simple reason, sorry. None of us has unlimited capital.
Correct.
Now, if you have unlimited capital, infinity, right, you do not need portfolio management. You just keep on buying and buying and buying. But I guess most of us, if not all, have very limited bullets, as we call it. So we need to know how to optimize our capital allocations. All right. So essentially, this is the three main reasons. Now, on the professional level, portfolio management is also important because we need to systemize how we invest so that we can scale up. Now, I'm sure that among our listeners, there are people who aspires, to manage some money for their own family members, right? So imagine you're not just managing your portfolio, you manage your mom's portfolio, your brother's portfolio, your wife's portfolio, your children's portfolio. You need to have a system. And if you do not have a system, you cannot scale up. Simple as that.
So you mean that the portfolio management can be duplicated?
Yes, the strategies, the way we assess our performance, all right, the allocation can be systemized and duplicated. You're right. Okay, but that will not be the focus for today. All right. Now,
So how do we manage the portfolio? There's so many stocks out there. There are so many categories of stocks.
you're right. So I think let's to answer your question. Let's go through some very simple concepts. Then we talk about how to construct a very simple portfolio. Yeah. Now, let's. I always say whatever we do, whether it's investment or anything else in life, right? Always begin with the end clearly in your mind. For example, if you have 100,000 today and you want to invest in the stock market, do you go to the market and say, okay, what's up today and what shall I buy today? All right, how would you invest $100,000? A lot of people do not really go through that thought process before they actually go to the market, and that is why, like it or not, a lot of people do not succeed. There's a saying, if you fail to plan, you plan to fail. All right. So I know it's a bit corny, but it's very truthful. Now, how will we invest, whether it's 100,000 or 10,000 or 1 million? Basically, before you do that, you need to understand something first. You need to answer this question, which is, what is your KGAR target? Now, KGAR, for those of, I'm sure you are familiar with this, and in fact, in my first webinar with LifeChamp, I talk about this in length. KGAR stands for Compounding Annual Growth Rate. Now, a lot of people talk about KGAR or view KGAR on the stock level, but here we see it on the portfolio level. Now, imagine you have stock A that gives you X KGAR, stock B that gives you X KGAR, stock C, and so on and so forth. But collectively, how does it affect your portfolio KGAR? Okay. Now, for example, if you intend to grow your 100,000 or your capital in 5 years' time, so then your KGAR, if you remember the rule of 72, would be about 14 to 15% per annum. Now, you see, on a high level, you need to achieve that kind of KGAR. So does it mean that whatever stocks that you put in your portfolio needs to reflect that target as well? So you need to understand this first. Okay. Now, and why is this important? Because not every one of us will have different KGAR. Your KGAR could be higher than mine because maybe of our risk appetite.
Correct.
Okay. And the keyword here is risk, because your KGAR target will determine or will imply what is your risk tolerance. Now, when I say risk, it means are you game to invest in volatile business, or are you the type that prefers to see your investment grow slowly? Doesn't matter that it grows slower than your friends. All right, so you've got to understand this, because after you understand what is your risk tolerance, only you know what kind of stock you can invest in. Now, I'm sure that you guys will be asking this question. So how do we categorize the stocks? Yeah. Now, there are many ways. For the Spiral Thinker Alliance, we follow the method by Peter Lynch. Peter Lynch is the famous hedge fund manager who used to manage the Merrill Lynch fund. He wrote several books. One of the very famous book is called One Up on Wall Street. So in that book, he did explain about the 6 categories of stocks, starting from stalwarts to slow growth to fast growth, cyclicals, asset plays, and turnaround. Now, as you can see on the slides, starting from stalwarts all the way clockwise to turnaround, it is where the risk becomes higher. Right? Now, if you do not understand your risk tolerance, you may be taking too much risk when you buy a stock.
Correct.
On the other hand, you may be also taking too little risk. For example, Edna, if your personal KGAR target is, let's say, 30% per annum, okay, and you buy a stock like a very slow moving stock.
I will take forever to reach my KGAR.
Exactly. Now, on the other hand, if you are like me, where my KGAR, because or some other retirees where your KGAR is perhaps less, say 10% per annum, do you need to buy exciting stocks like
No,
Sakura?
definitely no.
Exactly. So we need to understand this. before we do anything, before we invest, before we construct portfolio, we need to understand our own KGA target, which is related to our risk tolerance. Then we know how to construct our portfolio. All right. Now, these are categories. So under each category, there will be, these categories are related to the business nature or the industry nature, not the stock nature. For example, cyclicals. It's very easy. I always pick this to explain because it's one of the easiest category to explain. Oil and gas is cyclical. All right. Commodity-based businesses are cyclical, like your palm oil. Okay. Technology, stock price-wise, yes, it does seem cyclical, but I'm from engineering background. In fact, my background is E&E. If you think about it, if you look at the big picture, does the human society needs will be more and more dependent on technology?
Yes.
Exactly. But okay, so in terms of the importance of technology, right, it will continue to grow. In fact, it will compound fast. But the demand and supply of technology, the materials, the devices is cyclical. Why? Because the demand for technology devices is actually depending on whether we feel rich or not. Think about it. Okay, in tough times like this, do you think most of us can afford a 5,000-6,000 ringgit iPhone?
No.
We go for the cheaper models, right?
Right.
But you see, we will need it, but we will shift our preferences. All right. So in effect, it does make depending on the kind of stock, technology stock that you invest in, it may look a bit cyclical. On the other hand, if you are the type that does not like volatility, you just want to see your portfolio grow, slowly but surely, right? You can go for stalwarts. Stalwarts are usually big conglomerates or big companies that are already established and they are very well managed. Personally, I like multinational companies like Nestle, Carlsberg, Heineken, which are managed professionally. You won't make a lot of money. But if you talk about Nestle is a bit of a abnormal since last year because the share price doubled up in less than 1 year. But if you look at long-term view, these are the companies that will slowly grow in value. They give good dividends. All right, they won't grow. They are not sexy stocks. The business is actually very boring, but they are good if you have very low risk tolerance. Okay. Now, if you can understand this, all right, then we can already start to construct a portfolio. Now, what you see in front of you is a sample portfolio construction for a 400,000 ringgit portfolio. Okay, the price is as of 28th of September, so it's quite outdated, but that is not important. The important thing is look at the allocation in percentage. So there are 7 stocks ranging from Nestle, Heineken, Tune Protect, Getronic, UGTech, Elsoft, and Unisem. But look at the allocation. So we allocate 15% or equivalent of 60,000 ringgit for this portfolio for Nestle. The same for 60,000 for Heineken, for Getronic, UGTech, Elsoft, and Unisem. And we allocate slightly less, 40,000 or 10% for a higher risk stock, Tune Pro, which is going through a turnaround phase.
So everything is balanced out, the allocation? Yes.
So depending on your risk, for this portfolio, it is quite, we call it a moderate risk profile. So our target is 15% per annum. There is actually a way to calculate that, but that is not the topic today. Now, the important thing here is the keyword is allocation. Now, when we say allocate, for example, Anna, let's say you do an annual budget. Okay, you say next year I'm going to allocate, say, X amount of money to go vacation. Do you straight away spend it all one shot? No, right? You allocate and you set aside. Now, the same concept applies in portfolio management. When you construct a portfolio, you allocate a percentage of your money, your capital, to invest in this stock. It doesn't mean that when Monday comes, stock market opens, you deploy everything. Why? Simply because we never know what's going to happen in the stock market. All right, because you never know. Okay, for example, if you start to buy, let's say at 146.4, you silent everything. What happens if the week after that it dropped to 130 ringgit? We never know, right? So what we're afraid of is when a good company share price drop, we do not have money. But here we say we allocate first, then we wait for the durian to drop. Okay, that is basically our strategy, which I talk about in my first webinar as well.
For the value investing.
Correct. So over here, if you look at this table as well, if you look on the rightmost column, there's a thing called the strategy. Now, this is also depending on whether you are the type that likes to look at the stock market every day, or you're the type like yourself who are busy organizing events, right? You don't have time to watch or to monitor. Then you should go for the passive strategy. Then you know what kind of stocks.
So for passive, it's just leaving the stock there.
Yeah. So, but doesn't mean that you just leave it there.
You don't
for passive
actively manage it.
Yes, but you need to follow the fundamental development. For example, every time there's a quarter report, you need to read it. You need to understand. Then you can decide by then, should I add more, status quo, or should I sell some based on fundamentals? Now, if you are the busy type who has absolutely no time, do you think you should buy a stock like Asia?
Yeah.
It goes up and down every day.
Cyclical, maybe no then.
Exactly, because you need to monitor it quite frequently, isn't it? Yeah, okay. So conversely, if you're the type that has too much time, I think a lot of our listeners are like this. You are you think the stock market is very exciting. Perhaps you want to go for the more active approach. Now, you see, whatever we do, we just give you an overview of a portfolio. And this is a very important step even before we go to the market to start to buy. We need to have this plan first. Otherwise, most of the time, we will lose our focus. Okay? Right.
What are some of the parameters we can start with?
Okay, this is a very good question. So basically, just now what we went through the concepts and this is a sample of a portfolio construction. Now, you don't have to follow exactly this. This is basically just a framework. All right, you can make it even simpler if you want. All right. Now, let's move on to basic parameters like what Edna mentioned. Now, the very first important parameter is basically just the portfolio value. What is the meaning of portfolio value? Does it mean that I add up all the market value of my stocks as my portfolio value? All right. Do I add in the cash? Now, for the purpose of our webinar and in our opinion, portfolio value is the sum of your cash balance, all right, inclusive, plus the market value of all your stocks in the portfolio. Okay, this is a very important concept because the cash balance and the stocks will interchange.
Yes.
Depending on your trading action.
How big of a portfolio value would you recommend for someone?
Well, it depends. If you are normally when investors are quite young, they don't have a big capital. On the other hand, more senior investors, because they have gone through the employment cycle, they're cash rich, they're more assets, right? Their portfolio will be bigger. All right. So in fact, it depends on you. So I can share with you, my youngest brother, when he went to college, all right, to study architecture, I said, "Hey, bro, give me all your ang bao money, 12,000 ringgit. Not a lot, but still we can manage it." Then understanding the risk tolerance of this investor, also the portfolio size, then you know what kind of stocks to buy. For example, if a 12,000 ringgit portfolio, can you buy a stock like Nestle?
Yes, but
You
very
can't.
limited.
12,000 you can't, because 100 Nestle shares the minimum is already 14,000 ringgit.
Yeah,
You see what I mean?
The current price.
In that case, you may want to go for lower price stocks. When I say lower price, doesn't mean cheap. Okay, just lower price.
Lower value.
Yes. All right. So now, this is a very important concept. So you have to remember this portfolio value equals to the cash balance plus the market value of the stocks, and this is time sensitive. You know why? Because your stock price changes every day.
Yes.
So the right hand side of the equation will change. All right. Even though you don't trade, your cash balance stays the same, but the market value will change. So naturally, your portfolio value will change along every day. Okay. Now, when we start a portfolio just now, let's say 400,000 ringgit, it's when we open a trading account with our favorite broker, right? We will ask to write in a check or bank in, right? So all portfolios started with all cash in first.
Correct.
Last time, many years ago, you can do margins. I mean, you put zero capital, but you can enjoy margins, but no more, right? So all portfolios started with 100% cash. Now, after a while, after some time, you will take some of the cash to buy some stocks in it. Okay. Now, let's say you buy 3 stocks. maybe after some time, that 3 stocks will have a market value. You add that market value, total it out, you add it with the cash balance, that will make your portfolio value at that point in time. Okay. Now, what happens to your portfolio value? What happens to this dynamics every time you buy and sell? It's very simple. Now, as you can see, every time you buy a stock, so you take money out from your cash balance, your trust account, to buy the stock from the seller. All right, so you deduct cash from your balance. Now, conversely, every time you sell a stock,
You get cash.
you get cash back. Now, this is a very important concept, although it's very simple because it's about risk. Now, when money is in your trust account, is it subject to risk?
Yes.
What kind of risk? In your trust account.
In your trust account.
And it's like as good as in your hands.
Okay.
Is this not subject to any risk of the market risk? Sorry.
No.
No, right?
No.
But once you deploy this capital, this cash into the market, you buy a stock.
You're subjected to many risks.
Yes, you're subject to the volatility, market sentiments, the company fundamentals, things like that, right? So when we deploy cash into the stock market, we are basically putting our money at risk. Now, conversely, when you sell a stock, we're taking the risk back. Okay. Then what other things will constitute our cash balance? Most of the brokers these days, they give interest rates. Depending on the brokers, some may give you 2%, 2.6%. I even know some that give 3%, and it's daily rest some more. Every end of the month, they'll credit the interest to your cash, your trust account. And how about dividends? Dividends received on your stock should go back to your cash balance.
Correct.
And the worst thing now, I don't know what's the reason, but the system today is the dividends you receive goes to your savings account, which is not your trust account.
Okay.
It's not the trust account in your portfolio. So to be a successful investor, you've got to be disciplined to remember to put
don't spend your money.
Yeah, think about what did you do with your last dividends received. Now, the reason is very simple. If you can compound your portfolio, let's say just 10% per annum, and imagine you do not repatriate back your dividends into your portfolio. Basically, that's opportunity cost, isn't it?
Yes.
Yeah. Okay. So these are very simple concept. All right. But it's very important. It's very essential. Portfolio value equals to cash balance plus your market value of stocks. Okay. Now moving forward, how do we manage or how do we monitor our portfolio? There are many, in fact, these days with apps and everything, right? There are so many options out there. But personally, in my group, we use our own Excel platform, our own Excel sheet. Plus, there's another thing called, if you are those type who are lazy to update Excel, you can use i3. i3 Investor is a free platform. All right, whereby you can, they have a portfolio function whereby you can just key in your cash, your trades in the system, and they will calculate your portfolio value, your performance for you guys. So this is basically a snapshot. All right, for example, in this pie chart, it basically tells you what are the allocation of my portfolio. For example, or if you see on the middle one, the blue color, which is about 38%, is basically Tune Protect. And then the next biggest one, which is 20%, is actually cash.
This is the market value lah.
Yes, you're right. The market value. So it helps you track the end of day price. It's not real time, but it's end of day. Okay.
So you don't have to do the calculation yourself.
You don't have to do calculation, but you have to key in your trades and your dividends received and your interest received. That is the only manual thing that you do, or you can hire somebody to do it for you. Okay. Now, for ourselves, we have our own Excel system. All right. Basically, this is what it looks like. I know it may look a bit complicated, but basically it's divided to 4 quadrants. So for today, we're going to focus on the quadrant which is highlighted in the red box. So this is what we call quadrant 1, which tracks the profitability of your stocks. So this is on the stock level. Okay. Now I'm going to go through some very basic parameters that you can understand very easily, that you can start to use or apply in your own portfolio. Now, although the naming can be different, but the concept is basically the same with the i3. The i3 can have different names, but the concept is the same. Now, focus on the table in front of you on the headers in dark blue. So we've got stock, quantity, ABC, price, market value, P&L percentage, PW. What do they all mean? So we're going to go through them one by one. Okay. First of all, stock. Is it important?
No, it's just a stock code name.
Oh, you'll be surprised. But okay, for example, to me, stock name is very important because you've got to understand what you're buying. I know a lot of people, they like to say, hey, you think 2345 can buy?
Okay.
What is 2345? It's a stock code, but what
You don't even remember what is it.
exactly, you don't even know what is the company behind. So are you investing or are you speculating? Don't forget, we are talking about investing. Now, if you want to speculate, by all means go ahead, but know what you're doing. Okay, how about even stock name? If I mention to you, YTL.
Which YTL?
Which YTL? All right, Genting.
Which Genting?
Very, very hot these days, right?
Yeah.
Is it Genting Plantation, Genting Malaysia, Genting, so on and so forth. So stock name is very important. Okay. Next thing is actually the quantity. Now, when we talk about quantity here, it's actually the net quantity. Why? Because along the way, for sure you'll be buying and selling. All right. So you need to track your trading history so that you know what is the balanced quantity of shares that you have in your hand. And why is it important? Because you need that information to calculate your ABC, which stands for your average balance cost per share. Now, this is perhaps one of the most important reference point in portfolio management. It's basically like a GPS, all right, your guiding point. Basic average balance cost, all right, technically, the formula goes like this. It's your total buy value, your contract value, your total purchases, take away the total sell value, take away the dividends you receive for that stock. Now you take that and you divide by the balance quantity you have. All right, what is left is actually your average balance cost. Now, for example, say we have a very simple example. Say we buy a stock today, $1, 10,000 shares. So how much is our total buy value?
10,000.
10,000, and our balance quantity is 10,000. So our average balance cost is $1 per share. All right. Now, let's say this is a good business. In very short time, it doubled out to $2. So in terms of risk management, purely looking at risk, what should we be doing?
Sell to break even.
We should sell, right? But it's a great company. Should we sell everything? No, right? Now, let's just say that $2, say we sell 5,000 shares.
So we'll get 10,000 to break even.
5,000 shares multiplied by $2 per share, we get 10,000 ringgit. Hold on. What was our initial capital outlay?
10,000.
10,000. We put 10,000 in the market. We take 10,000 back. So our cost is actually zero. But do we still have balanced quantity?
Yes.
So this is basically what we call free shares. Now, in the journey of our portfolio management, we aspire to have as many free shares as possible. Would you like that?
Yeah.
Now, as long as it's a good company that keeps on, it's like basically like a goose that lays you golden eggs. You just let it keep on growing, isn't it? And you want to own it for free. Okay. Now, this is a very interesting concept. Now, that is why the dividends received, you need to plow back, because dividends received actually reduces your capital at risk. Remember our earlier slides here? That's why this is a very important concept. Dividends received actually means you take money, the company pays you dividend in dollars and cents, you put it back into your cash balance. So the effect is it reduces your capital, your risk exposure.
So that is why we have to be disciplined enough
right.
to put it back to the right account. All right.
Yes. So it's like, you own a property and you rent it out, all right, and then you receive rental every year, every month, every year. It reduces your cost of holding the property, right? It's the same here. It's just that this time, instead of a property, the asset is actually an equity, a stock, a business. Okay. Now, the next group of parameters is basically the price. I think price everybody knows. For portfolio management, basically we look at the end of day price. Okay, we look at end of day because we need to see what is our portfolio value at the end of the day. If you're the busy type, you can do it in a week. Or if you're the super busy type, you can do it every month. So it depends on your style. Okay. Now, market value is basically taking the balance quantity of shares multiplied by the share price, the market price. So that will make the market value. Okay. Now, how do we know whether we're making money or not? Right? For that stock. Basically, we take the market value minus the average balance cost per share.
Okay.
Then we multiply by the quantity of shares. That will indicate our profit or loss.
And it will change every day.
Yeah, it will change every day. Okay. And then, so this on the stock level, if let's say this stock gives us a profit of 1,000 ringgit, does it mean anything?
No.
No, right? See, a 1,000 ringgit profit on a 10,000 ringgit portfolio is a huge deal because it's 10% of a portfolio,
Yes.
right? But what if this 1,000 ringgit profit is actually on a 1 million portfolio? That's only 0.1%. All right. So you see the relativity. Okay. That's why we need to understand the profit or loss in terms of percentage. Now the loss is also the same. Okay. In a portfolio, we need to look at the profits as well as the loss. All right. We cannot lie to ourselves. Oh, I only report my profits. Okay. And the final and most also very important parameter is actually the PW, which is the portfolio weightage. Now, portfolio weightage basically means you take the market value of the stock and you compare it with your total portfolio value. For example, you have a stock A, all right, and this stock A, the market value you multiply by the quantity, let's say is 30,000 ringgit, and 30,000 ringgit, let's say on a 100,000 ringgit portfolio, that's 30%. Depending on your risk tolerance, maybe 30% is okay, just nice. But if to a risk averse person, wow, 30%,
It's big.
I'm exposing myself quite heavily on this particular
So
stock.
they may want to cut down on the weightage.
So if you know that, you can track that, you may want to take some actions, some remedy actions. You may want to reduce your exposure. All right. Now this is where the P&L comes in. It is easy for you to reduce exposure if it's profitable. If it's losing money, you may be scratching your head. Ayah, sayang, right? Okay, that's why portfolio management, we look at the portfolio on a high level. We look at it like a business. All right, before we take actions, okay, we need to consider some things. Now, this is very different from most of us who just tend to buy and sell on impulse. Or your friends say, yeah, and now very good, you should buy now. Then after you buy, next week you see the share price crash 10%, then you got fearful, you sell, right? But if you have a portfolio management system, it actually helps you be less emotional and be more objective in your investment.
Be more logical.
Yes,
by just looking at the facts.
Yes, by looking at the parameters and the statistics.
All right. So does it mean that if let's say I have a portfolio weightage, which is a quite big amount, let's say 30%, like you mentioned, does it mean I have to spend more time on that portfolio weightage?
First of all, you have to understand why is it at 30% and not 10% or 20% or 15%. Is it because you know that, or you are very confident that this business is going to perform well this year? Or is there any catalyst that you foresee that this business is going to do well? All right. In that case, then it gives you a reason to put more money into this. Now, a lot of people don't know that, because especially if you don't track your trading, you keep on buy. Later on, you found, 50% exposed to this stock. All right. So whether it's right or wrong, it depends on you. Depends on the portfolio at that time. What is your strategy? What is your plan? All right. So that part is a portfolio strategy. Management is just managing. The strategy part comes first, actually. Okay. To me, 30% is quite okay. But as a rule of thumb, I wouldn't advocate anything more than 30% unless you have absolute very good reason. Yeah. Okay. All right.
So is there any way we can minimize our portfolio risk?
Well, okay, I think that's a very good question, because I think the next chapter is about optimizing our risk and performance. Now, here the keyword is actually optimize. Very important. What is the meaning of optimize?
To make do the best.
The best, balance it out, but the best. Okay. Now, I don't believe in maximizing risk or maximizing performance. There's no such thing. But I believe in the find the balance point. Okay. So let's tackle this topic by going through a case study. that is in front of us. So this is basically a sample portfolio from the earlier case. I think this is a portfolio that started 100,000 ringgit about 5 years ago. Okay, now if you can see from here, you notice that actually very clearly that there are two stocks that are highlighted in blue.
Yes.
The reason is because the portfolio weightage is more than 20%. So for example, Tune Pro is a 26% weightage. Unisem is 30% weightage.
Okay.
You may be thinking, David, why are you so confident in Unisem? Because Unisem lately they received an offer from a Chinese peer to buy a stake in the company. But we have started investing in Unisem before that. Why? Because it's basically a price to value divergence, which we talk about in my first webinar. And as you can see here, even though the portfolio weightage is 30%, so maybe I use this for a bit. Can they see the pointer?
Yeah.
Okay. Although the portfolio weightage is 30%, but look at what is the average balance cost per share.
2 ringgit.
It's about 260, right? So the price now is about 320, which means that this portfolio is this stock is making money for the portfolio. Now the absolute portfolio in absolute profit in ringgit term is 10,000 ringgit, $700 ringgit, right? Which represents about 5.7% of your portfolio value. Okay, but it's weighted at 30%. Okay, now on the other hand, I have another stock also close to 30%, but it's losing money. So you see, and the reason why this is losing money is because we started buying this stock at high price, about 80 over cents, if I can remember. And as the share price comes down, right, we're buying slowly. That's why we are still in the losing money today. So as in the portfolio, you have to recognize the losses as well as the gains. Okay. Now, if we just look at this, so other than this very obvious, pointer. Other than this very obvious risk or concentration risk where we have two stocks that has more than 50% of our portfolio weightage, there is another angle we can look at. Now, if you look closely, I have a 30% weightage on this portfolio from a business of the same group. If you look at it, you look at AHL and Tune Pro, they basically belong to the Tune Group or Tony Fernandez company.
I see, okay.
So if you add 26% to about 8%, so you get about 34%.
Okay.
Now imagine I have another stock called AHX in this portfolio. The concentration will be even higher, right? Then you got to ask yourself, am I taking too much risk on one company or one group? All right. So you may want to consider this. Now the third one is actually exposure to industry. Now you can see that from here, I have stocks like Getronic, which is from technology. I've got Unisem technology. Ugitech, yes, but personally I won't. Okay, generally we can say it's technology and Elsoft. So if you add the weightage of these four stocks, it's close to 50% as well. Now, imagine what will happen to the portfolio performance if when the tech industry suffers because of the trade war between US and China. Do you think this portfolio will suffer with this 47% weightage? Definitely, right? And that's what happened to this portfolio for this year. All right, it dropped. Why? Because there's a high concentration on technology stocks and it came down. All right, but then you got to ask yourself, what's happening to the market? How is it affecting the businesses in our portfolio? So this is something that you have to understand of a business. That's why you really need to understand what you're investing in. For personally, for my case, for this portfolio, I'm very confident that all the tech stocks in this portfolio eventually should rise to the challenge. They should do very well. Yes, maybe for the time being, they may suffer because of the negative setbacks in the industry. Could be because of the lousy iPhone sales or the trade war, right? It may affect the business temporarily, but over time, we are very confident that it should perform very well. All right, so I'm okay with the temporary setback, and this is something that each of us may differ. All right, so if you type that cannot withstand this kind of risk, then you should not have such a high exposure on the company level or on a industry level.
So maybe they should limit themselves to 2 stocks per industry.
Right. Not the number of stocks per se, but more on the portfolio weightage. Because you can have those stocks but only 10% of our portfolio,
Okay.
then it's still okay. All right. Now, imagine what will happen when, let's say, the technology industry
Booms.
does well again. It's cyclical, as you say, right? Next year, do you think this portfolio will revive?
Yeah.
Yes, exactly. Now, so far, I have even not talked about portfolio performance yet. It's just basically managing the risk. Okay. Of course, then we talk at risk. We need to talk about performance, right? Most of the time, when we talk about performance, we look at the portfolio. What is the absolute return on my portfolio, right? But if you think about it, does it make any sense? Okay, say,
How significant is the absolute return?
okay, let me put in other words. Oh, I double up in my portfolio already. Does it sounds good?
Sounds good.
Sounds good, right? But if I tell you further, give you more details, I double my portfolio in 20 years. That's equivalent to 3% per annum, right? Might as well put your money in FD, isn't it?
Yes.
Now, doubling your money in 20 years is very different from doubling money in 10 years. Doubling your money in 10 years is very different from doubling your money in 5 years. Okay, so instead of just looking at the absolute return on a specific point in time, normally from a portfolio management perspective, we would like to look at the time perspective, okay, time series. Now, this is the portfolio performance evolution of this particular sample portfolio, which has been ongoing for about 5 years. Now, as you can see here, it is very important for us to do this. Unfortunately, i3 do not have this feature. This is basically from our Excel sheet. Now, if you can see this line here, this red dotted line, it denotes our CAGR target. Remember, earlier on we talked about CAGR. So for this particular portfolio, the target is 15% per annum, which is to double the money in 5 years' time or less. Okay. Now, this is very important because, again, this is like our GPS. Now,
if you are heading in the right direction.
Yes, if you're heading in the direction, because you need to assess your goals. All right. If we are lagging behind, should we do something to our portfolio today to revive it, or we are ahead of our target? Should we start to take more profit? All right. Now, for example, if you can follow the laser pointer at this point in time, what do you see here? The portfolio performance, is it on, above, or below our CAGR target?
Below. Far
right?
below.
So this happened in the middle of 2014, when AirAsia, we started investing in AirAsia for this portfolio at 2.30 cents per share. It crashed to 80 cents in less than 4 months' time. So naturally, this portfolio suffered because AirAsia is again an highly exposed stock in this portfolio. So you see, there's a pros and cons. Okay. Now, at this point in time, you may be thinking, should we relook at our strategy, or is there something wrong with our stock picks? If you feel there is, then perhaps you may want to do mitigation measures like rebalancing. All right. In this portfolio's case, back in the middle of 2014, we saw that there's nothing wrong with AirAsia. In fact, AirAsia was doing very well in terms of the cash flow for operations. That's why we decided to put more capital. We decided to sell some other stocks, use the money raised to buy more AirAsia. Now, when AirAsia rebounded, you see what happened to the portfolio? In less than 1 year's time, it actually surpasses our 15% CAGR target. Now, logically, at this point in time, we are so much ahead of our CAGR target. Can we take less risk?
Yes.
Meaning, we can sell more shares to raise more money in cash balance. Remember, we talked about earlier on?
Free shares.
Not about free shares, about risk. When we buy stocks, we're transferring the risk into the market. But when we sell the shares, we take back the capital, so it's less risk. So it's the same concept here. That's why earlier on, I need to talk about those very simple concepts. Now, over time, of course, if you manage your portfolio well, we should be able to double our money within our stipulated target. Now, this is a very real case study. Over here, at the end of 2017, you see the portfolio has doubled out from 100,000 to 200,000 in 4 years' time, which means that my CAGR target is more than 15% per annum already. By right, from a risk management perspective, what should we be doing?
Should be minimizing your risk.
We should be minimizing, right? But did we do it? No, we didn't. And this is a very real personal experience. Why? Because you remember back in 2017, before the end of the year, when our Bank Negara reported our economic numbers, everything was tip-top. Our manufacturing grew, especially electronics, remember?
Yep.
Our GDP was doing very well. So nobody would anticipated all the events that have happened in 2018. So we are human as well. Please do not think that we only make money, we also lose money. In fact, if you look at the portfolio, year to year, year on year, we actually lost money. But overall, are we still on track?
Yes.
Yeah. All right, we are still on track. Okay, now, so as part of our continuing education services to the public, we actually host or we publish two of our model portfolios on our Facebook. If you don't mind, all right, if you can go to our Facebook, all right, our Facebook is called Financial Independence Express. If FIXPRESSMY, all right. So one of our posts is this one called "You are invited to witness our journey." All right. There are three model portfolios: 100,000 ringgit, 300,000 ringgit to suit your different needs, and exclusive $1 million portfolio for our graduates of IBICC, our value investing course. All right. Now, if you click on any of the link, it will direct you to the i3 Investors website, where we publish our portfolios, and you can see it here. All right, you can, in fact, if you want to track how we buy and sell, for example, you want to know how we lose money in TunePro, you can just tap on the shares, then you can straight away see what our trading actions for TunePro since the beginning. All right, now this is to show you that we are here for good. All right, we are value investors for the long term. So good time, bad times, we still report our numbers. Okay, and back to the Facebook post, you can see that this is the model portfolio. This is 100. The blue one is 100,000 ringgit. The yellow one is 300,000 ringgit. You just click the yellow one. All right, it's basically the same, right? So we still have the red line of the 15% KGAL target. Okay, so this is as of end of third quarter, August. Okay. So this portfolio was performing at that time. Now, we haven't updated this. I can tell you very honestly, today this portfolio is around here. It has dropped because in the fourth quarter, a lot of things has happened. All right, so a lot of stocks dropped in share price, so it affected our portfolio. Okay, so if you want to know more, you can drop to our Facebook, FIXPRESSMY. All right, you can look at it if you want. Now, okay, so just now I mentioned about AirAsia, right? So how we bought from 230 all the way to 80 cents, right? And we had
it rebounded.
Yeah. So okay, other than sorry, I think I jumping the gun a little bit. So again, let's go back to the performance part. Now, if you look at this same snapshot again of this portfolio, you notice that in the arrow that we have a few stocks whereby the ABC is 0.
Is that possible?
Yes, it's possible, and it's very possible if you have the discipline. Now, what is the meaning of ABC 0?
ABC 0 means your cost is 0.
Cost is 0, right? Meaning your capital at risk is 0. You have no risk for this particular stock. Okay, and how is this possible? It's very simple. Now, if you look at the formula again, ABC equals to the total buy value. Take away your total sell value, take away the dividends received, and divide by the balance quantity, right? That's your ABC, isn't it? Now, imagine if your total sell value and your dividends received is more than your buy value, meaning whatever you take back from the market is more than whatever you put into it.
So it's already profiting.
Correct. Meaning whatever is left is already profitable. Meaning your cost is more than it's actually more than free, meaning it's negative cost. All right, so this denotes your free shares. Now, in this portfolio, because of the trading actions, because of value stocks that came down in price, we actually took opportunity. That's why we have AirAsia at 0 cost, Getronic at 0 cost, and UGT at 0 cost.
So does it mean that the lower the value for ABC, the better it will be?
Well, the lower the value, meaning the lower the risk. For example, now AirAsia at this snapshot was trading at 2 ringgit 90 cents, and the cost is 0. Now and it's very important to look at what is the portfolio weightage. So it's about 7-8% right now. Okay, and you have, don't forget, you have 20% cash. Sorry, 19% cash. Right now, say something happened to AirAsia and it dropped to $2, 2 ringgit per share. My cost is 0. And assuming there's nothing wrong with the business and it's still on have positive outlook, can I buy back some shares?
Yes, you can.
Why? Because my cost is 0, isn't it?
So risk is 0.
Exactly. Now, if I visualize this this example, it's basically like this. When the share price comes down for whatever reason, our strategy is to buy in installment. As I mentioned earlier on, we allocate a certain sum of money to buy this stock. Doesn't mean that we deploy it one shot, because you never know, the market will give us
Opportunity.
a surprise like this. 4 months drop more than 70%. All right, you wish that you have some money to buy, isn't it? Okay. Now, when the stock's price comes down, okay, the blue line is the stock price. The red line is actually the average balance cost. All right. Now, as the stock price comes down, we will buy in installments. We'll never know when we can buy at the bottom. That's why we need to stagger it. Now, as the share price goes up, what do you think we were doing?
You start selling.
Exactly. So if I highlight, I'm not sure if you guys can see. Basically, black color shows that we are buying, and red color shows that we are selling. Okay, so we were basically buying all the way from 230 all the way to about, in this portfolio, I think the last buy was 1 ringgit. Why we stop at 1 ringgit and not 80 cents?
Because you're not sure whether the market will go lower.
No, because we don't have any more money. Right?
Okay.
So of course, fortunately, the business bounced back eventually in also it's very short amount of time. So as the share price goes up, what was our major trading action? Was it to buy or to sell?
To sell.
It's basically red color, which is to sell. Now, you see here, it's very important. Every time we sell, what happens to the average balance cost?
It goes down.
It goes down, right? Now, over here, even though our average balance cost is less than $1, and the share price was trading at 250, and let's say at that time, I remember AirAsia announced a very good quarter result. Can I buy back some shares?
Definitely.
Yeah. Although if I buy back some shares, it increases my average balance cost, but my new balance cost is still below the
share price.
So this is what we call margin of safety. Now, every time we engage in trading action, we always have this in mind. Okay, we always have this in mind to track what is our margin of safety. Now, of course, not all stocks are performing as well as AirAsia. In fact, if we look at TunePro is still very much losing money. In fact, it's taking 12% out from this portfolio. Another stock, Elsa, which is just recently added in this portfolio, is still on a break even. Okay, so hopefully, over time, TunePro, again, it's a turnaround business. Then you may say, hey, David, turn around. How come you have 26%? All right, so at the end, it depends on your risk tolerance. Okay. Hopefully, over time, it should rebound back the business, which means we hope that naturally the share price should follow as well.
Now, I have a question.
Yep.
If we were to, let's say, right now you sell off all your TunePro, so will that make all the weightage in all your other stocks to be recalculated?
No. You see, assuming we can, because you see, now the TunePro, the market value is 49,600. Okay. Now, assuming if I can sell all the 80,000 shares at this market price, which means I get back, let's just ignore the trading cost, we get back 49,600. Remember our earlier slide? When we sell, where does the money go to?
Comes back to you.
Cash balance, right? Which means that this 49,600, you'll move from the equity into our cash. So the weightage will still be the same.
Okay.
But it's just that now, instead of that 26% risky,
it's not
now it's not in cash. All right. But what happens if TunePro were to go back up to $1? Then we lose the opportunity to make money.
Okay.
See, so it's always a balancing act. That's why optimizing your risk and your performance is absolute crucial. Okay. I think it's 9:30 right now.
Yeah.
Okay, I think basically that's what I want to share today. I would like to end my webinar by borrowing the very wise words from this very wise scientist called Lord Kelvin. He was the one that came up with the temperature measurement of Kelvin. He says that if you cannot measure it, you cannot improve it. That's why having a portfolio management system is very important for us to continually upgrade and improve our investment journey. And with that, I wish all our listeners all the best in your investment and in the coming year of 2019. Thank you very much for listening.
All right. Thank you, David, very much for your session today. Very informative, and I felt that I learned something about the importance of portfolio management. Definitely not something that everyone will put a lot of emphasis on. So for our listeners, if you have any questions regarding today's session, please feel free to type in your questions into the chat box. And we will go to our first question today.
Okay, before we go to the first question, can I just flash
Yeah, sure.
Yeah.
Please.
I forgot about this. So remember to go to like our Facebook where you can share, we can view our model portfolios. And I have a very short announcement to make. So if you enjoy our webinar today, we are going to have a market outlook event happening on the 12th of January at Top Glove Tower, and we will be featuring Top Glove as we will have invited Top Glove CFO to talk to our members to update us on the business performance. The business updates. So we will be publishing the event sometime this weekend. So if you're interested, please visit our Facebook after this weekend. We will publish the details for you guys. Thank you, Edna.
Sure.
So we can move on to the Q&A.
All right. Thank you, David. So our first question for tonight, Ken is asking, is there any book to recommend for portfolio management?
I think it's a great question. For portfolio management, I do recommend one book, but it's quite, it's not for beginners.
Very, very dry.
It's not dry, but it takes some intuition to really understand the what the author is trying to say. It is called it is called the author is Robert G. Hagstrom. Robert, if you
maybe you want to Google over
yeah,
here?
maybe you can
Yeah,
help.
you can.
I can.
Can.
So Robert G. Can they see this?
Yes.
Okay, books. Yeah. Yeah, this is the one. So if you guys would like, and you can look for this book called The Warren Buffett Portfolio by Robert G. Hagstrom. It's an absolutely must read if you are really serious in the portfolio management. But I've got to warn you guys, in this book, Hagstrom advocates that Warren Buffett's style is very focused. Actually, it's very in line. In fact, I learned that way as well. My strategy is also very focused. That's why you see 30% in one stock, 26% in one stock, right? But it doesn't mean that we are always 30% in that stock. In fact, when we reach our target for that stock, we will sell to reduce our exposure. For this book talks a lot more about that, other than the 12 tenets of Warren Buffett stock picking. So you see, stock picking is just one part of the skill. In fact, in my opinion, managing the portfolio is even more important than stock picking. All right. So if you like, you can buy this book. Unfortunately, I've tried to source for this book locally. I didn't get it. I actually got it from online, from this website called bookdepository.com. You can look up. All right.
All right.
Thank you for the question.
All right.
Ken?
Thank you, David. Okay. Our next question. How about portfolio management in terms of market? US, NASDAQ, NYSE, KLSE have different idiosyncrasies. So does different markets help due to geographical separation?
Yes, definitely. Simply because different markets have different dynamics and different ecosystem, different business landscape, different taxation structures. So you got to understand those things as well. Unless you are very familiar with the foreign markets, normally I would advocate not to touch. Unless you invest in business that are international, like Apple or Microsoft, where the products and services are everywhere, you can see it. Let's say I give you a company called XYZ LLC that only sells in United States, and we are here in Malaysia. How do we follow, right? So that's not even nothing about portfolio management anymore. So I am 100% invested in Malaysia for now. So I haven't diversified my assets in other markets, but that's something that we intend to do. But for now, we are 100% invested in Malaysia simply because we have the home ground advantage. We need to see what's happening to our business. We need to attend AGMs. All right. Now, if coming back to portfolio management angle again, other than the stock fundamentals, you need to also understand the other macro factors like interest rates. Let's not even talk about US. Let's talk about Singapore. Singapore, what's the FD rate? Less than 0.5, less than 1%, right? So if you have a asset that can yield you more than 1%, 2% is very good already. But in Malaysia, is 2% good? No, even FD is better than 2%, right? So you've got to understand the geographical diversification. So it's quite complicated. In fact, volatility as well. If you think Malaysian market is volatile, you should have seen US markets or even Hong Kong shares, right? They are even more volatile. So you've got to acknowledge that kind of risk before you go into. I'm not sure if I answered the question because I think the question is quite long. But
I think you answered it quite well.
Thank you.
Thank you, David. Okay, we have another attendee asking, how do you derive zero for the ABC?
Oh, good question. So I think I talked about that. Maybe I just recap. So if you look at the slides now, this is again the recap of the formula of the ABC, right? Now, if I may, easier pen. Now, I just separate to two groups. The first group is the total buy, and the second group is, okay, let me put green, is the total sell plus the total dividends received. Okay. Now, again, it's very simple. Whatever we buy, the total value, the contract value, right, over time, if it's less than whatever we get back after we sell and the dividends we receive, right, basically our average balance cost is zero. Okay. Again, let's just recap the simple example that we had earlier on. If we buy a stock today at $1 and 10,000 shares, that's 10,000 ringgit that we put into the market, right? We get the shares back. Okay. Now over time, let's say this business performed very well and doubled to $2 per share. Okay. And it's still a good business. We don't have to sell everything. Let's just say we sell half. We sell 5,000 shares. So what is the sell value that we get back? Let's forget about dividends first.
10,000.
10,000, right? So if you take the total buyer value of 10,000 minus the total sell value of 10,000 is zero. If you zero divide by whatever balance quantity, your ABC would be zero. Okay. Yep. Now, other than the trading action, the dividends received will also help us reduce our costs as well. But don't forget, just now the example is to trade on the right direction. Now, sometimes we may trade in the wrong direction. Meaning what? Let's say we bought 10,000 shares at $1. It went out to 150. We felt greedy. We buy 150. We buy even more. Then the share price goes back to $1 and we sell. Then it will actually increase our average balance cost. Yeah.
Okay.
So again, that is another skill set already. So you may apply whatever technical analysis or whatever skills that you have. You can do that if you think that it works for you, but it doesn't work for me at all. Basically, that are the different scenarios that may affect your ABC. Does that answer your question?
Yes, definitely.
Thank you.
Our next question: do you separate your portfolio by time frame, long run or short run?
Personally, I don't do that.
Because you are a value investor, right?
I'm a value investor and all my portfolios are for retirement. If I show you my personal portfolio, it'd be hard. Like that also can. You get all the Nestle, the classic Cynics, right, and the Getronics are all very boring one. Okay, but you can do that, yes. So, being human being, right? The gambling DNA is already ingrained in our blood, in our DNA, right? It's fine, it's fine. You want to speculate, it's no problem, but you need to know what you're doing. So you can have different portfolios for different objectives. For example, okay, I want to have one portfolio for my retirement, another portfolio for my children's education, maybe another small portfolio for play, for speculating, so that, things, life can be more interesting, right? You can do that. So in that case, you can separate your portfolios, not by different time frames, but for different objectives. But here, I must caution, know what you're doing. Don't put 100,000 ringgit in your retirement portfolio and 300,000 ringgit in your play account. Then it works the other way.
Yes.
Now, why? It's not about return, it's about risk. Now, you may make a lot of money in the play account, but if something were to happen to the market, like what's happened this year, right? Your play account may reduce substantially. 10% of 300,000 and 10% of 100,000 is very different. So you've got to know what you're doing. So instead of looking at it from a time frame perspective, I would advocate the listeners to do it on the objective basis.
Okay. All right.
And you don't have to manage portfolios for retirement. Very boring. Maybe you aspire to buy a house in 10 years time, and you can start today. And other than one lump sum, you can actually chip in your monthly savings every month. You can do that. Absolutely doable.
Okay, so objective based is the key word here.
Yes, objective based, you're right.
All right. Okay. We have a list attendee asking, is the current market position suitable for value investing? Our topic today is portfolio management, but if David, you want
yes,
to answer?
I think it's absolutely the time. Always people ask me, is this the right time to buy, to invest? I would say anytime is a good time to buy.
Yeah.
Because don't forget, when we say we invest, we allocate, doesn't mean that we spend all. All right? And that is why we need to understand all the different parameters that we talk about today. Okay, the portfolio weightage, the cash balance weightage. All right? And then we didn't talk about the timing part, which is on the second quadrant here, if you can see here. If I zoom in here, so this is the quadrant where we talk about the timing of the stock, where we have the 52-week volatility range, the 52-week low and 52-week high, the EY, the earnings yield, or it is the inverse of PE, the dividend yield, the operating cash flow yield, so on and so forth. So yes, we do consider this timing but it affects on how we deploy our portfolio, our capital. It doesn't dictate whether we should be invested or not. We always say that anytime is a good time to invest, because think about it, if we don't invest, where can we put our money?
It's the same as not investing.
Yeah, so because you see, don't forget here, how much we want to put in cash, sell to raise cash, and how much in equity is entirely depending to us. But make sure it is in the same account. Don't say, okay, my cash is in FD, then my trading account is different. It doesn't work. All right, you have to put it into one system so that you can manage it properly.
Okay. Thank you, David. Now, another attendee is asking, should we sell those stock with negative PL inside portfolio?
It depends. So let me answer your question in two angles. If your decision matrix or your decision point is because the P&L is negative, all right, not looking at the business, then I would say that you don't like to look at negative numbers in your portfolio. Okay, but if your decision point is because you don't foresee that this business is going to recover, you are not confident, all right, then perhaps you can reduce your exposure, or you can sell off everything, take the money and invest in some other stock that has a better prospect. Let me give you an example. So 2018 was a bad year for me personally, because I picked a lot of wrong stocks. So although I say stock picking is not important, but yes, it is important, but not the only thing that we should consider. So this year, one of the stocks that we picked is actually from the CPO industry. It's called the Boiler Makers. So we got CBIP and we got Boiler Max, because we thought that we saw the CPO cycle. Wow, CPO overall are so low already, for so many years. I think it should rebound, and some more with the trade war coming, right? We actually anticipate quite naively that China should be buying more CPO from us, right? If you don't buy soybean, right? But of course, as time has proven, we were wrong. All right, all the CPO players from upstream to midstream, right, was trashed. So we lost quite some money in these two stocks. And then at one point we asked ourselves, okay, are we confident that the CPO industry is going to recover next year or the year after that? After going through our research, our spiral thinker model, I said, okay, there's a very high chance that it will not recover, and even if it recovers, it won't be so substantial. So we decided to sack the companies, sell at a loss, take back the money, and deploy in other stocks. All right, so the other stocks that we deploy is in technology, because technology that time was also in a very, very low, but we see that technology has a much better prospect than the CPO in at least the next 1 or 2 years. Yeah. So again, I would implore you to go back to what is your decision-making point. If it's just looking at P&L, then actually it's up to you, it's your money, but I would advocate you to look more on the fundamental before you make a decision. Whatever portfolio actions that we do or we execute should always have a linkage to the fundamentals of the business of the individual stock. Yeah.
Okay, understood. Now, the CAGR you mentioned, usually how many years is the appropriate number of years?
Again, thank you for that question. It means that you haven't been paying attention. Okay, let me go back to the very first slide. Beginning with the end in mind, what is your CAGR target? And why is this important is because, look at this title here. Your CAGR target is related to your risk tolerance. Okay, so it depends. Again, I throw back the question to the listener or the viewer. What is your risk tolerance? Now, let me give you an example. If what is the person's name? Is it Daniel?
Roy.
Okay, Roy. Say Roy is a young person, student now, and he has so many good number of years in the future, which means what? Opportunities to make more money from income or from business or from employment, right? Then in that case, perhaps your risk tolerance should be higher, which means that your CAGR should be higher. Now, instead of, for me, I won't go more than 15%, but in that case, you may want to go for 18% or 20%. So for example, if your CAGR is 18%, then it means that you aspire to double your money in 4 years' time. If your CAGR is 24%, you want to double in 3 years' time. All right. So you see, you shorten the period, your doubling target, but it also means that you need to take more risk in the kind of stocks that you invest in. So you got to ask yourself. Now, on the other hand, if Roy is say nearing to the retirement age, whereby your chances to make money is getting less, because why? Nobody wants to work forever, right? You want to enjoy life, isn't it? Then you may not want to take more risk. So instead of planning your portfolio to reflect a 18% or even 15% CAGR, right? You may want to go lower, 12% per annum, or even 10%, which is good. And I have known a lot of people, very high net worth people, who are happy just to get 8% per annum. Why? Because when you have a lot of money, imagine yourself today, you have a lot of assets and money, right? What is your objective? What is your biggest objective? Is it to make more money or to preserve your wealth? To preserve, right? Now, in that case, you should take less risk. Instead of aiming for 15-20%, you should go for 12% or even lower than that. So I hope that answers Roy's question.
Actually, I think his question is asking what is the minimum and maximum year for CAGR? Like, do you put 5 year, 10 year, 15 year?
Minimum.
Do you have any minimum or maximum year for your CAGRs?
So again, as a rule of thumb, I will not go more than 15 to 18%. More than 18% is meaning you should be a very young person. For example, my youngest brother's portfolio was trading at 24% per annum because he's just starting that time. There's no maximum minimum. Again, it depends on your risk appetite.
Okay.
But as a value investor's perspective, I won't advocate more than 18%. And don't forget, Warren Buffett has been doing it for 50 years, and his CAGR was 20% per annum. So if you think you are better than Warren Buffett, then by all means, please go ahead.
Go ahead.
Yeah.
Okay, thank you, David. Now, do you do sectoral weightage in your portfolio, and how do we put weightage to each sector in the market?
Yes, I do. I do that very. I do it quite religiously. Being an engineer, I understand technology. So if I read a report on technology, for example, but as I read technology, right, the way the Spiral Thinker Alliance do research is not looking at ROE or PE. We actually look at what the business produces. I give you an example. A company like Getronic. Do you know what they produce?
No.
No, right? They produce, one of the products is actually the sensors in front of your phone. The new iPhones, the facial recognition, right? They produce those sensors. They also produce the LEDs at the back, the packaging. Okay, so unless you are very familiar with the industry, right, and you are very sure that this industry is going to do very well, I wouldn't advocate. I wouldn't recommend to have too much of a high weightage in the industry. So again, it's best to spread, but then again, it depends on your circle of competency. Again, I borrow the terms from Warren Buffett. Circle of competency means your knowledge about the industry. For example, if you are the type that has absolutely no knowledge about technology, do you think you should put money in the stock technology stocks?
Maybe not a heavy weightage.
Maybe not heavy weightage, or even not at all, because if there's something wrong, people like me who understand may be buying more, but you may be scared to sell. So it depends on your understanding as well. Every year we do have a market outlook. So for example, last year we decided to do focus on CPO. Look what happened. Yeah. So again, you can do this review every year, because most industries are cyclical. Okay. You may say, okay, maybe that next year you feel that the property or the construction may do well because it has been so low already, and the new government maybe they are outlaying certain measures to help boost the industry. So I don't know. So it depends on your circle of competency as well. Yeah.
Okay. Thank you, David. Now, our next question. KEGA is basically used to measure a closed-ended portfolio.
Yes, you're right.
How do you measure an open-ended portfolio when you still continuously pile in cash to the portfolio?
Well, that is a $1 million question. Now, you're right. So I think, who is this?
Ding Hao.
Oh, Ding Hao. Okay, I think I know Ding Hao. Wow, very smart question. KEGA is actually more suitable for a closed-ended portfolio. For open-end, there is another measurement method called IRR, internal rate of return, and that is even more complex. The reason why we use KEGA is because it's so easy to understand. All right, but again, KEGA has its own limitations. Now, if you use the i3 portfolio management system, they don't measure KEGA, they measure IRR. So IRR takes into account of the cash injection over time, as well as the cash withdrawals over time. So if I show you, Deng Hao, if you can go to now if you go to the i3 portfolio, the i3 system, the i3 portfolio system, if you click on wealth creation, okay, now if you see on the screen, you see that for this portfolio, the IRR, portfolio's internal rate of return from 29th of August 2016 to 4th of December 2018, which is 2.27 years, is only 5.7% per annum. So okay, so this is the current one, because the portfolio has dropped substantially in the last quarter. So this is the IRR, which takes into account of your cash injection and withdrawal over time. So again, maybe this is a smarter way. All right, but explaining the implication of IRR is actually very tough. So that's why normally when I teach or when I share with my friends, I don't use IRR. Yeah.
Okay, hope that answers your question, Deng Hao. Okay, our next question. If my cash balance is limited, to the 6 categories, can we only choose 3 categories, for example? If yes, which one will be the better category?
Oh yes. No, I show 6 categories doesn't mean that you must have all in 6 categories. You can have in one category. Okay. This is basically just the Peter Lynch 6 stock category. Depending on your risk tolerance again. All right. You need to choose your categories very carefully. And this question is from?
This is from Meiji.
Meiji, right? Okay, so Meiji, if you are the type that cannot stand to see your portfolio goes up and down, up and down, up and down, right? Meaning you cannot stand volatility, you should go for those more stable stocks. So those stocks will fall under the stalwarts and the slow growth category. But having said that, you've got to acknowledge that if you put most of your capital, your allocation into this category of stock, you cannot expect very high returns at 15%. So if your KR target is saying 8% per annum or 10% per annum, then you can go for this. Okay. Now, if Meiji is the type of investor who want to go for growth, who want to have high KR, again, meaning she can tolerate more risk, right? Then she can go for those more higher risk categories like fast growers, cyclical, or even turnaround. All right. But you've got to acknowledge that when you take more risk, it means that there is a higher chance also that you may lose your capital. Don't forget, especially for turnaround, the saying that Peter Lynch says that turnarounds seldom turn around. All right. Okay. So I hope that answers Meiji's question.
Okay, thank you, David. Next question from JJ. He's asking that, do you look at technical indicators when you are investing for long term, as in you buy the stocks with low price and then follow the market momentum and trend?
Sorry, I don't do that. In fact, when I started out investing, I was a chartist. I was a technical analyst because, being an engineer, if you ask me to look at the P&L and the financial statement, the numbers that made me fall asleep. Then I stumbled on I attended a course in PJ that showed me, wow, investing is so easy. In fact, the numbers are so simple. The maths are so simple compared to my engineering maths. So in fact, when I started out, like I mentioned, objective-based portfolios. I've got one value investing portfolio and one play account. Initially, for the first 6 months, my play account, which is based on the technical analysis, the Fibonacci, retracement, the momentum, the EMA, whatever you say, candlesticks, right, was doing very well. Then the market turns. Eventually, I realized actually the value investing portfolio, which requires much less of my time, performed much better over time because why? I invested in good companies. So again, depending on your skill sets, for me personally, I know that charting is not cut out for me, so I don't use charting in my investments. Purely fundamentals.
Okay, understand. Yeah. Thank you. Our next question from Shu Chen. How does margin financing affect portfolio management? Wow. Does it work with leverage?
Okay, I've got to be very firm here. I do not advocate margin. Please don't buy in margin unless you are the type. I was interviewed by Focus Malaysia last year. So the same question popped out. The theme of that article is, should we buy in margin? So my question in that time was, I split my answers to 3 buckets. So I'm going to say the same thing to you. This is Rachel, is it?
Shu Chen,
sorry. If you're the type of investor who doesn't have a lot of assets to back it up, please don't touch margin. I know there's a very famous philanthropist who advocates you should buy a margin, especially when you're young. Please don't do that because it's a double-edged sword. When people sell the concept of margin to you, they only sell to you the upside. They never tell you about the downside. Now, of course, if you buy a margin and the stock price goes up, you get more than your cap. You get more because of the leverage, right? But what happens is it goes the other way, right? You lose more than your capital. Okay, but on the other hand, if you are a high net worth person, you've got a lot of assets, you've got a lot of land, properties, whatever or assets, then you can use that as a leverage to take on margin. Why? Because you can use other people's money. Nowadays, margin, I think you can get for 5% per annum interest rates. So if you can get more than double of that, then you're doing good. But please, again, as a rule of thumb, I've got to make it very clear. Please, please, please do not buy on margin. All the portfolios that management strategies that we advocate is all cash upfront. Cash upfront, I underline cash upfront. No T plus 3, no T plus 4, please. In my personal experience as a chartist last time, I lost the most of the money in T plus 3 contra. Hear it from me first. Use my lesson as your experience as your lesson.
So you don't have to go through the same lesson.
Yes, please.
Okay,
All right.
Thank you, David. We are running short on time, so we will take our last 2 questions for tonight's session. Second last question. Do you always have some cash behind in your portfolio management? Are you always 100% invested?
Okay. I think that's a very good question, but unfortunately, we will not be able to go through the detail of the questions today. But to answer you in very simply, we do not specifically set aside cash for rainy days because our trading strategy, which is called market automation and security buffer, we already take care of that portion, the need for cash in case the share price come down. Remember when we construct a portfolio, if you can see from the slides in front of you, when we allocate, doesn't mean that we spend right away. Now, for example, in this case, let's say Nestle, we only get to buy 20,000 ringgit of Nestle, but we allocate 60,000. Then the 40,000, let's say over time, another good company, pops along. Can we use that 40,000 to allocate for another portfolio? Yes. All right. So our execution strategy do not need us to specifically set aside cash balance for rainy days.
Okay, understood.
Yeah.
All right, our last question for tonight. Let's see. Okay. Roy is asking which website is good to manage portfolio. So as David has mentioned earlier,
i3.
Yeah. Okay.
But these days there are a lot of apps actually. Yeah.
Okay. Now.
Any other question?
Last question.
Maybe some from other persons.
Okay. Yeah. From Steven. Is it a good time for semiconductors since Donald Trump and Xi Jinping have a latest deal till next year March?
Is that from Stephen Wong? Yeah, I know him. So the question is it a good time, right?
Yeah.
I think for the next 30 days, it should be good because I think they're on a truce for 30 days, right?
Yeah.
So there is an article there's a very famous blogger in Singapore. I think I forgot his name, but I think it's Professor Chan. He mentioned that actually the trade war is just Mr. Donald Trump's leverage to make sure that he can maintain his presidency. So it's the leverage. So now that he has continued his second half of the term, so I think for now, for the near future, I think should be fine. Semiconductors should not go down any further. But that said, actually the bigger problem with semiconductor now is there's a lot of hype built on consumer devices, especially for one brand, which is Apple. And like it or not, Malaysia, a lot of semiconductor producers are dependent on Apple as an end customer. All right, we don't sell directly to Apple, but we sell to our clients who actually supply to Apple as well. And Apple lately, since the demise of Mr. Steve Jobs, the founder, the Apple's company strategy has been, I think, ding dong zigzag too many times. I personally feel that the Apple may be under threat by other consumer big brands like Huawei or Chinese vendors as well. But that said, consumer devices is not the only technology sector. There are other electronic sector like automotive, all right, industrial electronics, robotics, AI, which is even more exciting. But again, I must advocate, if you are the type who do not understand technology or you're the type that cannot stand volatility, please consider and consider and consider again before you put money into technology stocks. I hope that answers your question, Stephen. Thank you very much.
Thank you, David. All right, so before we proceed, and let us launch a poll to understand what is your preference. Okay, so the poll for today is, do you actually bother to manage your portfolio? All right, I'll give you 15 seconds to answer yes, sometimes, or not at all.
I think we should have done this poll before and after, right? Before, okay,
Yeah.
ask then after then.
So
okay.
we ask after, so to see whether they
I make any impact or not.
Do you convert anybody or not?
Okay.
Okay.
55%, 53, not bad.
Okay, so all right, time's up. Okay, let me share the results. So 50% of you say that you actually bother to manage. Some 47 say sometimes, and 2% not at all. Okay, so we hope that after today, the 47% sometimes will convert into a full 100% yes. Okay, all right. So now back to our slides. Okay, so okay, all right. So thank you, David, for today's session.
Thank you, Anna. Thank you for listening in.
To get you started, Bursa Malaysia got a waiver on stamp duty on shares of mid and small cap companies, which will be waived effective 1st March 2018 for a period of 3 years. And on top of that, they also have a waiver on stamp duty for contract notes on ETF and structured warrants, which will be waived effective 1st January 2018, and also for a period of 3 years. So we hope that every one of you learned something tonight. And as we have already mentioned, this is our last webinar for the year, the English webinar series. If you would like to see more webinar series in next year, please feel free to write into us at webinar@mylifechamp.com.
If you have any questions, you can write to this email.
You can
as
also write to David at alpha@spiralthinker.com. Thank you very much, everyone, for your support for the webinar series. And we hope to see you again next year. Thank you, David, again.
Right, thank you. Thank you very much for listening, and wish you all the best in the investment journey. Yeah, happy value investing.
All right, thank you. Good night.
Good night. Okay, are we off?